Hi everyone, today I'm going to start my presentation by this following topic. What are the key components of the strategic profit model and how can it be used to examine the effect of logistics decisions? First of all, let's talk about the strategic profit model itself. The strategic profit models provide a method for calculating the return on equity. What is return on equity? The return on equity refers to a business profit relative to shareholders' equity, or, put another way, the effectiveness of the business at turning assets and the investment into profit. And for the manager and the company, the strategic profit model itself also is a tool for measuring purchase and supply financial impacts upon the organization, and is a tool to highlight how the purchase materials, inventories, investment in fixed assets, operating expense, and working capital all build up to three key components, which are net profit margin, assets turnover, and final one, the leverage. Let's move on to the first component, the net profit margin. The net profit margin is to measure the proportion of each sales dollar that is kept as profit, and it is divided by sales. And to determine the profit margin is to subtracting the total costs such as materials from the total sales to arrive at net income, then to divide the net income by the sales revenue to arrive at a percentage. Then the percentage will represent the net profit margin, and it is really heavily influenced by the managerial decisions. And let me give you an example for the calculation of the net profit margin. Let's say the company achieved 1.5 million in sales last year with the total cost of 1 million, and the net income equals to 1.5 million minus 1 million, or 50,000, let's say, yes. And to dividing the figures by 1.5 million, it will leave you with a profit margin of approximately 33%, and that results a higher profit margin and also a higher return on equity. Secondly, let's move on to the next components, the assets turnover. What is the assets turnover? Assets turnover is to measure a business efficiency at creating the revenue from its asset. Let's simply say it's about the efficiency of the capital employed by the company itself. And it also measures the efficiency of the capital employed by generating sales. And when the assets turnover decrease, the return on equity will be decreased too. And because the logistic decisions can really influence the speed of which invoices are paid and reflected in account receivable on the balance sheet, so all the data in the balance sheet will affect the assets turnover, and of course it also will affect the efficiency and the decision made by the manager itself in the company. Let me provide an example for a calculation of assets turnover. Calculate assets turnover is, let's say, by taking the sales revenue and dividing it by the total assets. So your company generates 1.2 million in sales with 4.6 million in assets, and you will divide 1.2 million by 4.6 million to determine your assets turnover, and it will finally hovers by 26%. If the assets turnover decrease, and the return on equity will be decreased too. Let's talk about the final components, the leverage. The leverage represents the final component, of course, and it also refers to the debt to equity ratio, or how much debt you take on relative to your business equity. And to calculate that is to taking your total liabilities such as mortgage and revolving lines of credit and dividing them by your total equity. If your business total liabilities equal 2.2 million and your business total equity is 5.9 million, and you will wind up with the leverage around 37%. And finally, I want to talk about some insights of the strategic profit model. And it's a very excellent tool for demonstrating how change in profit margin and leverage or assets turnover impact to business. And also provide a simple way to see or evaluate the change over time. However, the data has to be original, or otherwise the record provides little value because it's inaccurate. That's the end of my presentation. Thank you.